another edition of Taking Stock. This is the show where we prepare you for the coming week and we discuss all that transpired in the week gone by. I'm Sonia, and with me as always is Anuj. Anuj, what a week it was for the markets. When we started off, there was some amount of despondency, but then we made a dramatic comeback by the end of the week.
Yes, and at the end of the Friday, the Nifty was down just about 0.5%. So managed to recoup all the losses. Essentially, we are still in the range, right? And at moments, it's looked like, you know, the market has broken down or broken out, but we are still stuck in the range. I think the last week was interesting because we saw some signs of money shifting to IT and pharma, except for Friday when we again saw a big surge in banking. Now, the big question is, was Friday an aberration, or or was it the start of something else? But short of that, you'll still have to believe that the range-bound trade is likely to continue. The market still does not have enough trigger to either break out of 8650 or to go significantly below 8400 or 8300 as we saw on Friday. So as of now, stuck in range. Also, this week a lot of mid-caps corrected, Sonia, quite a bit. In fact, the mid-cap index underperformed. A lot of stocks like Kaveri Seeds and a couple of other names which disappointed on earnings, they corrected quite a bit. Subex was a case in point. So that's a space that you have to be cautious on now.
Indeed, and we had a lot of global and local cues to deal with this week, right? The Yuan devaluation, positive macro data from our own markets. But by the end of it, you get a feeling that the Nifty hasn't lost much ground. In fact, recovered a lot of what it lost by the end of the week.
So the last week has taught us one more thing. Every day we keep looking at SGX Nifty, US data, FNO data. Now we'll start tracking Yuan as well every day.
Yes, that's true. But let's get two guests into our conversation. Joining us now is Jonathan Schiessl of Ashburton, who tracks and has been a keen observer of the Indian markets. Jonathan, good to see you in on the show. It's been a very interesting week, not just for India, but for global markets as a whole, dealing with this whole Yuan devaluation crisis. Do you get a sense that the worst is over, or do you think that because of the devaluation of the Chinese currency, there could be some, snowball effect into other emerging markets?
Yeah, I'd agree with you. I think we're all getting a bit fed up, to be honest with you, of the Chinese constantly grabbing the headlines, either with the Yuan devaluation or the issues we've seen in the domestic stock market over the last couple of months as well. I think the message is quite clear coming out of China. It does leave somewhat of a cloud, I think, over the emerging markets as an asset class. I think in the short term, it probably encourages flows for the time being back into developed markets. Why? Because people really don't know the reasoning behind this so-called devaluation. And quite frankly, we don't really know how far it's going to go. There's a lot of speculation out there about the extent that that they could let the currency slide. And, obviously we're only a few days into it, so, it's a bit of wait and see.
Jonathan, hi. So what's your call on India now? Because you track both India and China. Our market has been a bit volatile, but it's been a relative sort of outperformer. From here on, at least on the broader market, from here on, do you think the Indian market can give good returns?
We're still hopeful. I think in the short term, as I said previously, it's going to have a little bit of a cloud over some investors who are just concerned about EM as an asset class. As an asset class, it has been underperforming. So there will be outflows from EM-type vehicles, which will have an impact on India. I think the Chinese move obviously puts a lot of pressure on the rupee, so therefore for dollar or sterling or foreign currency investors into India, obviously the returns are negative if you start taking the currency depreciation into account. That's external factors. The internal factors, obviously the data, certainly the inflation data, the WPI data, the trend, I guess, has got some investors rather hopeful of a surprise cut in interest rates. That, to our mind, remains a little bit difficult in the very short term. So I think, probably we're sort of feeling a little bit more cautious in the very short term, the next month or two, more for external factors than internal factors, but hopefully a little bit longer, we're still confident that the economy is gradually gathering pace and that earnings are basing out.
Okay, so confident for the longer term. But you know, Jonathan, this weekend we are celebrating our 69th year of independence. And same time last year, the mood from the FII or the foreign investment community was very different. It was extremely optimistic towards India. And that mood has dampened a bit this time. Have you either reduced allocation to the Indian markets, or do you plan to reduce allocation, or, you know, any changes that you've made to your portfolio?
Oh, not at all. You know, we're actually very pleased that some of the euphoric sort of sentiment that was around over Modi's election is pretty much gone. I still think there is some lingering hopes out there. We actually think, you know, that things actually are going pretty much according to our original plans. How we're positioned within the emerging world and India in particular, we haven't taken any money off the table. We added to India a couple of months back when it was underperforming. We're still very comfortable about it. We're probably still looking to allocate more to India if we're honest, but probably in the very short term, we just need to see, you know, the events that are going on in China, how far this devaluation goes, because obviously the ripple effects across the global economy will be major.
So from portfolio point of view, Jonathan, in India, what are the sectors that you would look to increase your positions in, or any sectors where you would like to trim your positions with the kind of moves that we have seen?
Yeah, I guess again, if you start, I guess investors probably are going back and looking over, you know, currency plays, you know, stocks which obviously have, you know, a benefit from this weakening rupee. So, you know, the obvious ones over this week have certainly been IT and healthcare, and obviously that they are slightly more external and more defensive as well in many respects. So those sectors have done well. We're still very much focused on overweights to financials, which has been a little bit painful over the last month or two. We're still very much overweight industrials and consumer-facing sectors. So we haven't really changed our stance, but obviously the market is flip-flopping all over the place in the short term.
Okay, just you know, just to throw some more color on the overweight on financials part, do you like the private sector or the public sector banks now? Because within the public sector lot, there is some hope that the government will, you know, put together measures to solve all of the ills in the public sector banking space. Would you buy those names, or do you still stick with the private sector lot?
Yeah, we haven't touched a public sector bank for a long time. You know, you've seen quite a change in valuations amongst that sector. You know, some of them are looking quite interesting from a valuation perspective. What keeps us more cautious is, you know, just waiting for the government to obviously the issue with their stretched balance sheets. Obviously, the government, the infusion needs to happen, and obviously the other thing we're looking for is a clear signal from government, an action from government, to see these banks being run in a more commercial manner, with external managements, and you know, competing more with the private sector banks, because otherwise, you know, over time, when you look at market share of public sector versus private sector, the private sector is gradually eating up market share of the public sector names, and unless we see more commercial management, I can't see that trend reversing.
Okay, Jonathan. So apart from currency and what's happening in China, what is the biggest risk to this market, especially in India?
I still think, obviously, a risk that EM generally, and particularly, you know, India, obviously external funding remains an Achilles heel to a degree. So therefore, people will remain focused on the FOMC and you know, if and when the Fed will raise rates. Obviously, you know, the currency, as you highlight, is certainly a big risk. If China does devalue significantly, that will put considerable pressure, I think, on certain segments of the Indian economy. Of course, India isn't a huge exporting powerhouse, but, you know, obviously from an employment perspective, the textiles industry is very important. So that would be a slight worry to us in some of those, you know, externally facing areas. I guess the last risk is obviously it seems like this parliamentary session was a complete washout. Lack of activity, that there were some lingering hopes that we'd see some progress, particularly on GST in this session. Nothing seems to be, unfortunately, happening on that front. So, you know, are there any residual bulls out there who are expecting quick bang reforms? And if there are, then perhaps they'll be disappointed at this stage.
Okay, that point is taken. Jonathan, thanks as always for joining us, and you have a good weekend. Thanks for speaking with us. That's the word coming in from Ashburton. They continue to be optimistic on the Indian markets in the longer term, and they may look to add into their positions as well. We'll take a short break on that note. When we come back, we'll speak with another market guest. But in the meantime, let's take you through some market opinion that we heard through the course of the week.
I think it's a very stock cherry-picking market where good stocks continue to do very well. In spite of the downturn, you see the good stocks are still doing well. The cutback comes for a very short period. So, yes, there is a market, there is an indices level, but there is also a level called fundamental stocks which are performing and continue to perform. I still hold the theory that through all this volatility, the man which is going to get butchered is the one who speculates in stocks. The investor in good quality stocks holding it is not going to be so badly affected. And you have enough cases now, whether it's pharma, whether it's automobile, whether it is IT. These stocks are rock solid today, and I don't think you need to change your strategy. The strategy should be avoid speculation, get back to fundamentals.
We've tested 7,900 recently. So my sense is in the 8,000, 8,200 range, there'll be enough reasons that you'll get for people to add to India, as it were. And, say 7, 8, 10% higher, 87, 8,800, or even a little shy of that. So the market is trying to, try to get out of this range, but I think it's not impossible that the market could spend a fair amount of time sort of churning in this. The market is making new lows in terms of stocks with as much gusto as it's making new highs. In fact, so I think this is one of those absolutely different kind of bull markets where in the same space you have two majors, one making new lifetime highs, one making new lifetime lows.